The idea that bond investors are smarter than stock investors stems from the unique characteristics and strategies involved in both markets. Bond investors tend to have a more conservative approach, prioritizing risk management and long-term stability, while stock investors may focus on higher returns with greater risk. Research suggests that bond traders, particularly those dealing with high-yield or junk bonds, often have insights that can predict stock market movements. For example, studies have shown that bond prices can respond more accurately to company earnings announcements than stock prices, indicating that bond investors may have a better grasp of a company's financial health. On the other hand, stock investors typically seek higher returns, which come with increased volatility and risk. Stocks offer ownership stakes in companies and the potential for significant gains, but they also expose investors to market swings. Bonds, conversely, provide fixed returns with lower risk, making them appealing for those seeking stability. However, it's important to note that each group operates with different goals. Stock investors often pursue higher gains at the cost of greater risk, while bond investors focus on preserving capital and ensuring steady returns. Both approaches require intelligence and skill, but in different areas of market analysis and risk tolerance. In terms of fundamental analysis, both bond and stock investors use deep analysis, but with different focuses due to the nature of their investments. Bond investors excel in analyzing a company's financial health and creditworthiness, as their returns depend on the issuer's ability to meet interest payments and return the principal at maturity. They focus on debt metrics such as leverage ratios, cash flows, and the likelihood of default. This requires a strong understanding of balance sheets, cash flow statements, and overall economic conditions that could affect interest rates or a company's ability to service debt. Stock investors, on the other hand, focus more on profitability, growth potential, and earnings prospects, making them experts in income statements and market dynamics. They scrutinize a company's competitive position, revenue growth, profit margins, and the potential for stock price appreciation or dividends. Stock investors analyze macroeconomic factors, but are typically more concerned with the business's future prospects and market sentiment. Overall, bond investors may have an edge in financial risk assessment and company stability, while stock investors are typically stronger in analyzing growth potential and market trends. The depth of fundamental analysis required in both fields is high, but each focuses on different aspects of a company's financial performance. When it comes to technical analysis, stock traders tend to have a stronger focus than bond traders. Stock traders often rely heavily on technical analysis, which involves studying price movements, volume, and other market indicators to predict future stock price trends. Stocks are traded in more liquid, volatile markets, making them more suitable for technical patterns like moving averages, oscillators, for instance RSI, candlestick charts, and chart patterns, for instance head and shoulders or flags. Technical analysis is widely used by stock investors because of the high liquidity and frequent price fluctuations in equity markets. This creates a wealth of historical data for identifying trends, momentum, and potential reversal points. In contrast, bond traders tend to rely more on macroeconomic factors and credit analysis than technical charts, especially because the bond market operates differently. Bonds are often traded over the counter and tend to be less volatile and less liquid compared to stocks, making them less ideal for traditional technical analysis. However, some technical tools like yield curves and interest rate trends may still be used by bond traders, particularly in the case of highly liquid bonds like government securities. Thus, while bond traders may occasionally use technical analysis, stock traders are generally better at and more reliant on technical analysis, as the nature of the stock market lends itself more effectively to this approach.